Quick note, this is for educational purposes only and not financial advice. Any decisions you make are your own responsibility, and trading involves risk. If you've ever felt that financial markets are complex, overwhelming, or reserved only for professionals, this is where that perception changes. The reality is that markets are not complicated because they are mysterious. They are complicated because they are layered. Once those layers are stripped back, what remains is something far more logical, structured, and understandable than most people expect. This video is designed to give you a complete foundational understanding of financial markets in a way that is clear, structured, and practical. Not theory for the sake of theory, but knowledge that forms the base of everything professional traders and investors do. By the end of this, you will understand what markets actually are, how they function, who participates in them, and why prices move. Financial markets are simply systems where buyers and sellers come together to exchange assets. That's it at the most basic level. But within that simple idea sits a global network involving trillions of dollars, institutions, governments, and individuals, all interacting continuously. Every price movement you see is the result of decisions being made in real time. What separates beginners from professionals is not access to markets. It is understanding how to interpret what is happening beneath the surface. Most people look at price. Professionals look at the forces driving that price. This is where your perspective begins to shift. Instead of seeing markets as random or unpredictable, you begin to see them as structured environments driven by supply, demand, expectations, and information. And once that shift happens, everything else starts to make sense. Before going any deeper, it is important to define what we actually mean by financial markets, because the term is often used broadly without real clarity. Financial markets are not one single entity. They are a collection of interconnected markets, each focused on different types of assets. You have the stock market, where shares of companies are bought and sold. You have the foreign exchange market, where currencies are traded. You have bond markets, commodities markets, derivatives markets, and more. Each one serves a specific purpose, but they are all linked through the global financial system. What makes this system powerful is that it allows capital to flow efficiently. Investors can allocate money where they believe it will generate returns. Businesses can raise funds to grow. Governments can finance spending, and traders can speculate on price movements. At the core of all of this is the concept of value. Every asset in every market is constantly being priced based on what participants believe it is worth. That belief is influenced by information, expectations, risk, and opportunity. For example, if investors believe a company will grow, its stock price may rise. If a country's economy strengthens, its currency may appreciate. If demand for a commodity increases, its price may move higher. What you are seeing in markets is not just numbers moving, you are seeing collective decision making at scale. Understanding this is the foundation of everything that follows. To understand how markets function, you need to understand the mechanism that drives every price movement, supply and demand. This is the most fundamental concept in all of financial markets, and yet it is often misunderstood or oversimplified. Every time a trade occurs, there is a buyer and a seller. The buyer believes the asset is worth more than the current price. The seller believes it is worth less, or at least that selling now is the better decision. Price moves based on which side is more aggressive. If there are more buyers than sellers, price tends to rise. If there are more sellers than buyers, price tends to fall. But it is not just about the number of participants, it is about the intensity of their actions. Large institutions, for example, can move markets significantly because of the size of their orders. A single decision from a major fund can shift supply and demand in a way that impacts price immediately. This is why markets are dynamic. They are constantly adjusting as new information enters the system. Economic data, central bank decisions, geopolitical events, and investor sentiment all influence how supply and demand evolves. The key insight here is that price is not random. It is a direct reflection of underlying pressure in the market. Once you begin to think in terms of supply and demand rather than just price movements, you start to see the logic behind market behavior. Now that you understand the basic mechanics, the next step is to understand who is actually participating in these markets. Because not all participants are the same and their motivations are very different. At the top level, you have institutional participants. These include banks, hedge funds, asset managers, pension funds, and central banks. These entities control the majority of capital in the market and are responsible for a significant portion of price movement. Then you have corporations. They participate in markets for practical reasons, such as hedging currency exposure or managing risk related to commodities. Their objective is not to speculate, but to stabilize their operations. Next, you have retail traders and investors. These are individuals participating in the market, often with smaller capital and shorter term perspectives. While they make up a large number of participants, their influence individually is relatively small compared to institutions. What matters is that each group behaves differently. Institutions tend to operate based on long-term strategies and large-scale capital allocation. Retail traders often react more emotionally and focus on short-term movements. Understanding these differences gives you an edge. Instead of treating all market activity as the same, you begin to recognize patterns in behavior. And when you understand behavior, you begin to understand movement. The final piece of the foundation is understanding why markets move in the first place. Because without this, everything else becomes surface level observation rather than deep understanding. Markets move because expectations change, not just because of what is happening now, but because of what participants believe will happen in the future. This is one of the most important concepts in trading. For example, if economic data comes out stronger than expected, markets may react positively. But if the data is strong and expected to be strong, the reaction may be minimal. The key driver is not the data itself, but how it compares to expectations. This is why markets can sometimes move in ways that seem counterintuitive. Good news can lead to falling prices, and bad news can lead to rising prices, depending on what was already priced in. At a deeper level, markets are constantly trying to anticipate future conditions. Interest rates, inflation, economic growth, corporate earnings, all of these factors are forward-looking in terms of how they are reflected in price. As a trader or investor, your role is not just to understand what is happening, it is to understand what the market expects and how those expectations might change, because that is where opportunity exists, and this is where the real learning begins. Building on that idea of expectations, it becomes clear that markets are not reacting to reality alone, but to the gap between reality and what was anticipated. This distinction is subtle, but it is one of the most important concepts you will ever understand. It explains why two identical pieces of news can produce completely different outcomes depending on context. When expectations are exceeded, markets tend to reprice aggressively. When expectations are missed, markets adjust in the opposite direction. But when expectations are met precisely, the market often does very little because the information was already incorporated into price beforehand. This is why professional participants spend so much time analyzing forecasts rather than just outcomes. They are constantly asking a forward-looking question. What does the market believe right now, and where could it be wrong? This is also where inefficiencies appear. If the market is overly optimistic or overly pessimistic, there is a misalignment between perception and reality. That misalignment creates opportunity. Understanding expectations shifts your thinking from reactive to anticipatory. Instead of responding to news, you begin to think about positioning ahead of it. Instead of asking what happened, you start asking what could happen next and how the market might respond. And this is where trading begins to move from observation into decision making. To deepen that understanding, it is important to explore how information actually enters the market, because markets do not move randomly. They move in response to new information being processed and acted upon by participants. Information comes in many forms: economic data releases, central bank announcements, corporate earnings reports, geopolitical developments, and even shifts in sentiment can all act as catalysts. Each piece of information has the potential to influence expectations and therefore influence price. However, not all information is equal. Some events have a far greater impact than others. For example, a central bank changing interest rates can move entire currency markets significantly, whereas a minor data release may have only a limited effect. The key is understanding which information matters most in a given context. Markets tend to focus on what is most relevant at that moment. During periods of inflation concern, inflation data becomes critical. During economic slowdowns, growth data takes priority. This means that market focus is constantly shifting. What matters today may not matter tomorrow. Professional traders adapt to this by continuously reassessing which factors are driving the market. Once you understand how information flows and how it is prioritized, you begin to see why markets behave the way they do during different conditions. Another essential concept is liquidity, which is often overlooked but plays a crucial role in how markets function. Liquidity refers to how easily an asset can be bought or sold without significantly affecting its price. Highly liquid markets, such as major currency pairs, allow for large transactions to occur with minimal impact on price. This is because there are many buyers and sellers at any given time. In contrast, less liquid markets can experience sharp price movements even with relatively small orders. Liquidity is not constant. It changes throughout the day and across different market conditions. During periods of high activity, such as major economic announcements, liquidity can increase as more participants enter the market. However, it can also disappear quickly if uncertainty rises. This is why price can sometimes move rapidly in short periods. It is not always because of a dramatic shift in value, but because there are fewer participants willing to transact at certain prices. Understanding liquidity helps explain volatility. It also highlights the importance of timing and execution. Entering or exiting positions in low liquidity conditions can lead to less favorable outcomes. This is one of the practical realities of trading that separates theory from real-world application. Closely related to liquidity is the concept of volatility. Volatility refers to the speed and magnitude of price movements. Some markets are relatively stable, while others can experience rapid and unpredictable changes. Volatility is not inherently good or bad. It simply reflects the level of uncertainty and activity within the market. Higher volatility often means greater opportunity, but it also comes with increased risk. Periods of low volatility tend to occur when there is little new information or when market participants are in agreement about value. In contrast, high volatility often emerges when there is disagreement, uncertainty, or significant new developments. For traders, understanding volatility is essential because it affects everything from position sizing to risk management. A strategy that works well in stable conditions may struggle in highly volatile environments. This is why professionals do not just analyze direction. They also analyze the environment in which price is moving. They ask whether conditions are calm or unstable, predictable or uncertain, because the environment determines how strategies perform and ultimately how outcomes unfold. As you begin to bring these concepts together, a clearer picture of financial markets starts to emerge. Markets are not chaotic systems driven by randomness. They are structured environments shaped by participants, information, expectations, liquidity, and volatility. Each of these elements interacts with the others. Information changes expectations. Expectations influence behavior. Behavior shifts supply and demand. Supply and demand move price. Liquidity and volatility determine how those movements unfold. What may appear complex at first is actually a series of interconnected mechanisms, each playing a role in the overall system. The challenge is not understanding each piece individually, but understanding how they fit together. This is where most traders struggle. They focus on isolated concepts without seeing the bigger picture. They look at price without understanding the forces behind it. They react to movement without understanding the context. The goal is to move beyond that, to develop a framework that allows you to interpret markets as a whole rather than as disconnected parts. Because once you see the structure clearly, you are no longer guessing, you are analyzing. At this stage, it is important to introduce the idea of market structure, because this is where many traders begin to transition from understanding theory to interpreting real behavior. Market structure refers to the way price moves over time, not just individual movements, but the overall pattern those movements create. When markets are trending, they tend to move in a consistent direction, forming a sequence of higher prices or lower prices over time. This reflects a sustained imbalance between buyers and sellers. In contrast, when markets are ranging, price moves within a more contained area, reflecting a temporary balance between supply and demand. Understanding this distinction is essential because it tells you what kind of environment you are operating in. Trying to trade a trending strategy in a ranging market, or vice versa, is one of the most common mistakes. What professionals do differently is that they first identify the structure and then adapt their approach accordingly. They do not impose a fixed method onto the market. They align with the conditions that already exist. Market structure is not about predicting the future with certainty. It is about recognizing the current state of the market and adjusting your thinking to match it. Once you understand structure, you stop fighting the market and start working with it. Another critical concept is time horizon. Not all market participants are operating on the same time frame, and this has a significant impact on how price moves. Long-term investors may hold positions for months or years, basing decisions on macroeconomic trends and fundamental value. Short-term traders may hold positions for minutes or hours, focusing on immediate price fluctuations. In between, you have swing traders and position traders operating across days or weeks. Each of these participants contributes to the overall movement of the market. At times, their actions align, creating strong directional moves. At other times, they conflict, leading to choppy or indecisive price behavior. Understanding time horizons helps explain why markets can move in multiple directions within the same period. A long-term uptrend can still contain short-term pullbacks. A short-term rally can occur within a broader downtrend. For you as a trader, clarity on your own time frame is essential. Without it, you risk being influenced by movements that are irrelevant to your strategy. Professionals are very clear about the time frame they operate in, and they filter information accordingly. This clarity creates consistency, which is one of the key building blocks of long-term success. As you continue to build your understanding, it becomes clear that financial markets are deeply influenced by macroeconomic forces. These are the broad economic factors that shape the overall direction of markets over time. Key macroeconomic drivers include interest rates, inflation, economic growth, and employment. These factors influence how capital flows across the global economy. For example, higher interest rates in one country can attract investment, strengthening its currency. Weak economic growth can reduce confidence and lead to capital outflows. Central banks play a major role in this process. By adjusting interest rates and controlling monetary policy, they influence borrowing costs, spending, and investment. Their decisions can have a significant impact on financial markets. What makes macroeconomics powerful is that it provides a framework for understanding why markets move over the longer term. While short-term movements may be driven by sentiment or technical factors, long-term trends are often rooted in economic fundamentals. This is why professional traders pay close attention to macro conditions. They are not just looking at price, they are analyzing the underlying forces that drive that price. Once you understand these forces, market movements begin to make far more sense. Closely linked to macroeconomics is the concept of sentiment, which reflects how market participants feel about current and future conditions. Sentiment can be optimistic, pessimistic, or uncertain, and it plays a significant role in driving price movements. When sentiment is positive, participants are more willing to take risk, which can push prices higher. When sentiment is negative, risk aversion increases, often leading to declining prices. Periods of uncertainty can result in volatile and unpredictable behavior. What makes sentiment particularly important is that it can amplify or distort underlying fundamentals. Markets can become overly optimistic or overly pessimistic, leading to prices that deviate from what might be considered fair value. This is where opportunities can emerge. When sentiment becomes extreme, there is often a higher probability of reversal or correction as expectations adjust. However, sentiment is not always easy to measure directly. It must often be inferred from market behavior, positioning, and reactions to news. Professionals develop an awareness of sentiment by observing how markets respond to information, rather than just the information itself. This allows them to gauge not just what is happening, but how the market is interpreting it. As these concepts come together, you begin to see that financial markets operate as a complex but logical system. Both each element, structure, time horizon, macroeconomics, and sentiment provides a different lens through which to interpret price movement. The key is integration. No single concept is sufficient on its own. Market structure tells you how price is behaving. Time horizon tells you how to interpret that behavior. Macroeconomics explains the underlying drivers. Sentiment reveals how participants are reacting. When these elements align, market movements tend to be more sustained and predictable. When they conflict, markets often become unstable or difficult to interpret. This is where most traders struggle. They rely on one dimension of analysis and ignore the others. As a result, their understanding is incomplete and their decisions lack consistency. The objective is to build a framework that incorporates all of these elements in a structured way, not to complicate your thinking, but to organize it. Because once your thinking is structured, your decision making becomes clearer. And when your decision making is clear, your actions become consistent. At this point, it becomes necessary to address something that often confuses new traders: the difference between price and value. These two concepts are related, but they are not the same, and understanding that distinction is fundamental to interpreting markets correctly. Price is simply the level at which an asset is currently trading. It is the result of the most recent agreement between buyers and sellers. Value, on the other hand, is what market participants believe that asset is actually worth based on underlying factors such as earnings, economic conditions, or future expectations. Markets are constantly attempting to reconcile price with value. When price is below perceived value, buyers tend to step in, pushing price higher. When price is above perceived value, sellers become more active, driving price lower. However, value itself is not fixed. It changes as new information becomes available and as expectations evolve. This means that price is always adjusting, not just to current conditions, but to changing perceptions of the future. This is why markets can appear to overshoot in both directions. At times, price can move far above or below what might be considered reasonable, driven by strong sentiment or momentum. Understanding this relationship helps you avoid a common mistake, assuming that price alone tells the full story. It does not. It is only one part of a much larger equation. Another important concept to grasp is the role of leverage. Leverage allows market participants to control larger positions with a smaller amount of capital. While this can amplify returns, it also significantly increases risk. In many financial markets, particularly in foreign exchange and derivatives, leverage is widely used. This means that even small price movements can result in substantial gains or losses relative to the capital committed. The presence of leverage has a profound impact on market behavior. It can accelerate price movements, increase volatility, and lead to rapid changes in positioning. When markets move against leverage participants, forced liquidations can occur, further amplifying price swings. This is why risk management is so critical. Without it, leverage can quickly lead to significant losses. Professional traders understand this and use leverage carefully, always within a structured risk framework. For beginners, it is essential to recognize that leverage is not an advantage in itself. It is a tool, and like any tool, it must be used with precision and discipline. Misused, it becomes one of the fastest ways to lose capital. As you continue to build your understanding, it becomes clear that financial markets are not isolated systems. They are deeply interconnected, with movements in one market often influencing others. For example, changes in interest rates can impact currencies, which in turn can affect commodities and equities. A strengthening currency may reduce the competitiveness of exports, influencing stock markets. Rising bond yields can shift capital away from equities and into fixed income assets. This interconnectedness is often referred to as cross-market relationships. It means that no market operates in complete isolation. Instead, they form part of a broader financial ecosystem. Understanding these relationships allows you to see the bigger picture. Instead of analyzing a single asset in isolation, you begin to consider how different markets interact and influence each other. This adds another layer of depth to your analysis. It helps explain why certain movements occur and provides additional context for decision making. Professionals constantly monitor multiple markets, not because they trade all of them, but because they understand that each one provides information about the others. At this stage, it is also important to introduce the concept of efficiency. Financial markets are often described as efficient, meaning that prices reflect all available information. While this is true to some extent, it is not absolute. Markets are efficient in the sense that information is quickly incorporated into price. However, they are not perfectly efficient because participants interpret information differently. This leads to disagreement and therefore to opportunity. If all participants agreed on value at all times, price would not move. It is the presence of differing opinions that creates movement. Some participants may react quickly to new information, while others may take time to adjust. This creates short-term inefficiencies, where price may not fully reflect underlying conditions. These inefficiencies are where traders seek to find an edge. However, it is important to approach this realistically. Markets are competitive environments, and any inefficiency that exists is often temporary. Identifying and acting on it requires skill, discipline, and consistency. Understanding efficiency helps set realistic expectations. It reinforces the idea that markets are not easy to exploit, but they are not impossible either. Bringing everything together, you can now see that financial markets operate through a combination of structure, behavior, and interaction. Price is influenced by supply and demand, shaped by expectations, driven by information, and affected by liquidity and volatility. Participants operate across different time horizons, influenced by macroeconomic conditions and sentiment. Markets are interconnected, and inefficiencies arise from differences in interpretation and behavior. What may have initially appeared complex is now starting to form a coherent system. Each concept builds on the last, creating a layered understanding of how markets function. The objective is not to memorize individual ideas, but to internalize how they connect, because it is that connection that allows you to interpret markets effectively. From here, the focus shifts towards thinking like a professional, not just understanding the components of the market, but learning how to apply that understanding in a structured and disciplined way. And this is where the real transformation begins. At this stage, the focus shifts from understanding markets to thinking within them in a structured, professional way. Because knowledge alone is not enough. What matters is how that knowledge is organized and applied when decisions need to be made. Professional traders do not approach markets with random ideas or isolated observations. They operate within frameworks. A framework is simply a structured way of analyzing information, prioritizing what matters, and making consistent decisions based on that process. Without a framework, everything feels uncertain. One day you might focus on news, the next day on price movement, and the day after on something entirely different. This leads to inconsistency, and inconsistency leads to poor results. A professional framework, on the other hand, creates clarity. It defines what you look at, in what order, and how you interpret it. It allows you to filter out noise and focus only on what is relevant to your strategy. This does not mean that outcomes become certain. Markets are inherently uncertain, but your process becomes stable, and that stability is what allows for long-term performance. The goal is not to predict perfectly, it is to think clearly and act consistently. Within that framework, one of the most important skills is prioritization. Markets are filled with information, but not all of it matters equally. In fact, most of it is irrelevant to your specific decision at any given time. Professional traders are highly selective. They identify the key drivers of the market in the current environment and focus on those, rather than trying to analyze everything at once. For example, during periods where central bank policy is dominant, interest rate expectations become the primary focus. Other data points still exist, but they carry less weight. In a different environment, growth or inflation may take precedence. This ability to prioritize is what creates clarity. It simplifies decision making without oversimplifying the market itself. It allows you to concentrate on what is most likely to influence price, rather than becoming overwhelmed by unnecessary detail. This is where many traders struggle. They try to consider everything, and as a result they end up understanding nothing with real depth. Clarity comes from focus, not from quantity. Another defining characteristic of professional thinking is the acceptance of uncertainty. This may seem counterintuitive at first, but it is essential. Markets do not offer certainty, they offer probabilities. Every decision you make is based on an assessment of what is more likely to happen, not what is guaranteed to happen. Beginners often look for confirmation or certainty before acting. Professionals understand that certainty does not exist, and waiting for it usually means missing opportunities. Instead, they think in terms of risk and reward. They assess whether the potential upside, justifies the potential downside given the probabilities involved. If it does, they act. If it does not, they wait. This shift in mindset is critical. It moves you away from emotional decision making and towards structured reasoning. You are no longer trying to be right all the time. You are trying to make decisions that are favorable over time. And that distinction changes everything. Risk management naturally follows from this way of thinking. If outcomes are uncertain, then managing risk becomes the most important part of the process. Professional traders do not focus on how much they can make, they focus on how much they can lose. This may seem conservative, but it is what allows them to stay in the game long enough to benefit from opportunities. Every decision is made with risk in mind. Position size, entry timing, and exit strategy are all structured to control downside exposure. Losses are accepted as part of the process, but they are kept within predefined limits. This creates stability. Even during periods of poor performance, risk management ensures that losses remain manageable. Over time, this allows the positive outcomes to outweigh the negative ones. Without risk management, even a strong understanding of markets is not enough, because a few uncontrolled losses can outweigh many successful decisions. This is one of the clearest distinctions between amateurs and professionals. Professionals survive first and profit second. The final piece of professional thinking is consistency, not in outcomes but in process, because outcomes will always vary, but your approach should not. Consistency means applying the same framework, the same logic, and the same discipline across every decision. It means following your process even when recent results have been good or bad. This is where discipline becomes essential. It is easy to follow a process when things are working. It is much harder when they are not. But it is precisely during those periods that consistency matters most. Professional traders understand that performance is measured over a series of decisions, not a single outcome. They do not judge their process based on one trade. They evaluate it over time. This long-term perspective allows them to remain stable in the face of short-term fluctuations. Consistency is what turns knowledge into performance. And once you achieve that, you move from understanding markets to operating within them effectively. With a structured way of thinking in place, the next step is to understand how this translates into a practical decision-making process. Because ultimately, everything comes down to how you move from analysis to action. A professional approach begins with context. Before any decision is made, there is a clear understanding of the broader environment. What is driving the market right now? Is it interest rates, economic growth, inflation, or risk sentiment? Identifying this sets the foundation for everything that follows. From there, the focus narrows. Instead of looking at the entire market, attention is directed towards specific opportunities that align with that broader context. This might involve identifying assets that are particularly sensitive to the current drivers. Once an opportunity is identified, the next step is validation. Does the idea make sense across multiple dimensions? Does it align with market structure, sentiment, and the broader environment? If it does, it moves forward. If not, it is discarded. Only then does execution come into play. Entry, position size, and risk parameters are defined before any action is taken. There is no improvisation at this stage, only implementation of a predefined plan. This structured process is what separates deliberate decisions from reactive ones. Execution itself is often underestimated, but it plays a crucial role in overall performance. Even a strong idea can produce poor results if it is executed poorly. Execution is about precision. It involves entering the market at a point that aligns with your analysis, managing the position as it develops, and exiting according to your predefined plan. Each of these steps requires discipline. One of the key challenges in execution is emotional control. When markets move quickly, it is easy to deviate from your plan. You may enter too early, exit too late, or change your position based on short-term fluctuations. This is where preparation becomes critical. A well-defined plan reduces the need for on-the-spot decision-making. It allows you to act with clarity rather than emotion. Execution also involves accepting outcomes. Not every decision will be profitable, even if the process is correct. What matters is that each decision is made consistently and in line with your framework. Over time, strong execution ensures that your edge, whatever it may be, is actually realized in your results. As you apply this process repeatedly, patterns begin to emerge. You start to recognize certain conditions where markets behave in predictable ways and others where they become more difficult to interpret. This is where experience begins to compound, not through memorization, but through exposure. Each decision adds to your understanding, refining your ability to interpret the market. However, this only happens if your process is consistent. If your approach changes constantly, it becomes impossible to learn effectively from outcomes. You cannot improve something that is not stable. Tracking and reviewing your decisions is an important part of this process. It allows you to identify strengths, weaknesses, and areas for improvement. It turns experience into structured learning rather than random observation. This is how progression occurs, not through shortcuts, but through repetition, reflection, and refinement. Over time, your understanding deepens and your decision-making becomes more precise. Stepping back, you can now see the full picture of what financial markets represent and how they function. What began as a simple concept of buyers and sellers has evolved into a structured system driven by multiple interconnected forces. You understand that price is shaped by supply and demand, influenced by expectations, and driven by information. You recognize the role of liquidity and volatility, the importance of time horizons, and the impact of macroeconomic forces and sentiment. You have also seen how professional thinking transforms this understanding into a structured approach. Frameworks, prioritization, probability-based decision-making, risk management, and consistency all play a role in turning knowledge into performance. What is important is not just knowing these concepts, but understanding how they fit together, because it is that integration that allows you to interpret markets effectively. This is the foundation. Everything else you learn builds on top of this. The final takeaway is this: financial markets are not something to be mastered quickly. They require time, discipline, and a structured approach to learning and application. But they are not inaccessible. With the right framework, the right mindset, and consistent effort, they become understandable and, more importantly, navigable. The objective is not perfection, it is progression. Each step you take builds on the last, gradually improving your ability to interpret and act within the market. If you focus on developing a clear process, managing risk, and maintaining consistency, you place yourself in a position where improvement becomes inevitable. This is what separates those who struggle from those who succeed. Not talent, but approach. And once that approach is in place, financial markets are no longer overwhelming. They become an environment you can operate in with clarity, structure, and confidence. If you found this valuable, make sure to like, comment, and share your biggest takeaway, and subscribe for the next video in the series.